After more than 4 years of trading, spending thousands of dollars on courses and education, and losing a lot of money along the way, I discovered that every profitable strategy is built on two concepts. And if you don't truly understand these two concepts, it's going to be incredibly difficult to actually become profitable, no matter what strategy you are actually using. They're also the exact concepts that helped me generate multiple six figures in profits this year alone. So in this video, I'm going to break them down step by step and show you exactly how to apply them on the chart. And also I'm gonna explain how I use them in my trading every single day. And the best part is that you don't need to sit in front of the charts all day. You only need 60 to 90 minutes a day. So let's get into it. So just before we get into the video, you can see right here my profits from the last 6 months, and also you can see June of 2026, which was the last month. You can basically see every single losing day and every single winning day that this model gave me. So you can see it's connected to Tradezella, so a broker, and that's basically it. And right now when you've seen this, we can actually get to the video. So it actually took me 4 years of losing to actually understand what I will actually show you right now in this video. So let's get right into it. So the step number one is going to be to choose your model. So you know how you have a lot of models out there, like for example support and resistance, ICT, smart money concepts, you have overview strategy, trend lines, all of that. But what we are gonna learn and use is going to be the most simplest one and the most logical one, and that is going to be ICT/SMC model. So basically it is going to have two core concepts, and it is what is actually going to give us huge win rate and all of the simplicity. So it looks complicated right now, but later when we break it down into the two simple concepts is when it actually gets so simple. So we are going to start with the first concept, then we are going to go to the second one, then we will connect everything together, and after that we will actually go to the live chart examples. So let's start with the first concept. So the first concept is just going to be the direction in the market, and basically what is that? It's just whether the market is going to the upside or whether the market is going to the downside. So in this example right here, you can see market is making pushes to the upside and making small little pullbacks to the downside. So it's going to be really easy to determine the market direction, because you are just going to see whether it's market pushing up or whether it's market pushing down. And the second concept is going to be liquidity. So liquidity is something actually very simple, but yet so many people seem to not understand it. So let me explain you what the liquidity is. So basically, you know how in the market we are always making highs or we are making lows. So in the market there is countless of highs and lows in the market, but something that is special about all those highs and lows is that there is going to be a lot of stop losses on them. So basically we have a high right here, and when market starts reversing, a lot of people are going to enter short positions, and where are they going to put their stop losses? On the most recent high. Same as when we make this retracement and start pushing to the upside, basically all the people trading in the market, not all but a lot of them, are going to start entering long positions, and what are they going to do? They are going to place their stop losses on the most recent low. So basically when I say that most of the traders are going to place their stop losses, that actually means that there is going to be millions and millions of stop losses on these lows and highs. And basically what does that mean for us? That means for us, since we know that huge majority of traders are not profitable, so about 80 to 95% of traders are not actually profitable, we know that these stop losses are going to get hit, and they're going to get hunted by who? By actual market makers, which are banks, institutions, and the people who are trading with billions of dollars. So basically how the liquidity is going to be used is we are always going to like to see the sweeps in the market, the manipulations, and then after that we are actually going to look for those moves in the direction that we want to see the market moving. So basically in the market, when we have a uptrend, for example like this, we have a market direction that is going to the upside, what we are going to want to see in the market is going to be a manipulation that is going to look like this. So we are going to have a low in the market that was made, that is of course filled with stop losses. We are going to mark it out as a liquidity in the market, and basically what the market is going to do, market is going to likely sweep that low, and followed by that, since we are in a clear uptrend making pushes to the upside, we are just going to continue that direction. Also, here is one more trick to kind of find out whether we are in a uptrend or whether we are in a downtrend. So basically right here you can see we are pushing to the upside, making retracement down, and then making another push. You can see how the market is breaking these highs really strongly. So then, for example, in this move right here to the downside, what can we see? We can actually see that the candle that swept this low right here was really weak and had no volume to the downside at all. So it tried to go down but ended up closing above that low and just left a wick. But then on the other hand, if we look at this high right here, and if we look at a candle that broke it, we can see that there is pure volume inside of this candle. So you can see a strong closure above, which is indicating to us that market is really likely to continue, of course, making structure to the upside and just continue uptrending. But here you can see the market just completely swept this low and then started going up. But here you can just see a pure volume to the upside, which is indicating to us that still buyers are in control. So now that we know the first concept and we know the second concept, so a market structure and direction, and then a liquidity in the market, we actually need to put them together in the strategy. So basically all the concepts are useless without having a proven strategy that actually works. And the whole point of that strategy is to know when and how to enter a trade, to not just guess on the charts, but to actually have all the rules necessary to enter the market. And the final touch to the strategy is going to be fair value gaps, and they are going to tell us the whole rest of the story on how to enter the market. So basically what a fair value gap is in the market is, you can see right here we have one candlestick, then we have a second one right here, and then a third one right here. So basically a fair value gap is going to have three candles like this, and this hole in between is going to be our fair value gap or an imbalance in the market. Here we can see the same thing since the wicks of this and this candle are not overlapping. And how are we gonna use these fair value gaps? So what the market likes to do, market really likes to retest the fair value gaps and then continue going that direction. And same when we made them to the downside, market likes to retest them and then continue going to the downside. But we are gonna kind of look at them the opposite way. So basically what we are gonna do is, after we get the sweep in the market, so this is gonna sweep of, let's say, a high when we want to short the market, and this is going to be sweep of the low in the market, so a liquidity low in the market when we want to long the market and continue the uptrend. We are actually going to use fair value gaps when they actually fail. And why is that? Because when we sweep the liquidity, so manipulate to the upside, we will wait for the last fair value gap to get disrespected towards the downside, and that is when we are going to enter the market targeting downside, because we know that the fair value gap failed, got disrespected, instead of pushing the market up. And then also same in this example right here, when we manipulate towards the downside, sweep the liquidity point or the low in the market, we want to see a last fair value gap, which is this one right here, get disrespected, because then after that we enter the market and then we target towards the upside, because the fair value gap actually failed. But if it didn't get disrespected and if we didn't close with this body right here above, so basically the whole point is that the body or the candle needs to close below or above the fair value gap to get disrespected, then of course market would really likely reject it down. So right now, when we know all the concepts and the strategy, how to connect it together, let's actually go to the real examples on the chart. Right, so here we are in the live market, and of course we are just going to go with a simple concept and we are just going to do the normal analysis. So the first thing we need to do in the market is we need to realize the direction of the market, so where the market is headed towards to. So you can easily spot that market is just obviously going down with a small retracement and then a strong pushes like this. You can see that market is clearly downtrending. Also, how you can spot that is, since the market is really strong, breaking of course lows, and you can see also right here really huge volume to break the low in the market. So basically right now what we want to see is going to be the second concept. So the first one was direction, which is clearly direction towards the downside. The second one is going to be liquidity. So liquidity is every single high and low in the market, and if you mark out the structure, we can clearly see that this right here is the most recent high in the market. So what we do is we mark it out like this. Also, one more thing that we can throw into the model is the fair value gaps. So as I told you, fair value gaps like to get retested and to reject the price, and then also for the entry model we want to see them disrespected. So we can also add that confluence in the market. So you can see right here we actually have a fair value gap that is above this liquidity. So what is potentially going to happen in the market is we are going to sweep this high right here, and then we can also retest this fair value gap and of course continue the downtrend. So this is something that we want to see in the market. So if I fast forward the market, we can actually see if that is going to happen. So you can see right here we swept and manipulated the liquidity, and then followed by that we actually tapped into this fair value gap. So what we are going to do right now is we are going to scale down to the lower time frame. So for example, right now we are on the hourly, we scale to the 50-minute and the 5-minute time frame to search for an entry. So this is the 50-minute time frame, and if I zoom in, you can see that right here we have a beautiful fair value gap in the market. So right here what we can do is we can draw this fair value gap right here, and then you know what we are waiting for. We are waiting for the disrespect towards the downside, because if we get that, we can clearly enter the market and target liquidity to the downside. So let's see if that is something that is going to happen. So there it is. So this was a disrespect. We can also check out the lower time frame, which is a 5-minute, and you can see the same thing happened on the 5-minute just a bit earlier. So a 5-minute before we had a closure and an entry right here, but that is completely fine. So we are just going to enter the market based off what the 50-minute gave us. So we enter the short position like this, we put our stop loss. We don't want to put it too tight like this, we want to actually give it some room, and then what we do is we target the structure to the downside. So this low all the way that we actually left in the last push to the downside, and then we can fast forward the market and actually see what is going to happen, and you can see almost 3 risk to reward really quickly in the market. Alright, so here we are in a little bit more complicated market. So in this market conditions, it is going to be just a bit harder to actually realize where we need to trace towards. So you can see that market is kind of staying in the same place. So it's going to be a lot harder for us to actually realize, are we uptrending or are we downtrending? But before I tell you how we are going to realize it, if you really do like the video, make sure to leave a like and also subscribe to the channel so you don't miss any new videos. And also you can apply for the one-on-one mentorship to skip all the hard learning that you have to do. And basically with all of that being said, let's actually get to how to actually realize where the market is headed towards this. So in this example, we are going to use the candle closures. So in this example, we are going to use the candle volume and the candle closure. So basically we talked about how it's really important to see whether the market closes a high or low with a volume or without. So basically in this example, you can see that right here to the downside, we just kind of swept this low. So if the market really was bearish and wanted to go down, it wouldn't just sweep this low and then continue to the upside. But then on the other hand, if we look at the next candle that clearly has a lot of volume and just completely skyrocketed to the upside and closed really strongly. So this right here is the picture where the market is actually headed. So we didn't want to go down, but then to the upside we shot to the sky and we actually closed really strongly to the upside. So what we are going to do is we are going to scale down to the time frame below to actually search for an entry model. So what we want to see on this smaller time frame is of course long positions, but we first want to see a fair value gap get respected. So this one got disrespected, so it's out of the way, but then we also have this fair value gap right here. So basically what we want to see in the market is the market coming down, getting into this fair value gap and then trading to the upside. So if I fast forward the market and of course go to the lower time frame, you can see that on the 1-minute time frame we entered beautifully into this fair value gap, and what we can do is we can wait for some long positions to happen to the upside, and you can see right there this was the most recent fair value gap. So we had 2, we had 1 like this, and then we had 1 like this. You can also connect them to how I did before because they're just way too close and they look like one fair value gap. So what you do is you enter the market and then you target of course the biggest structure to the upside. That is going to be about 2.7 risk to reward. So let's see how this trade is actually gonna play out. So if I extend this and let the market play forward, you can see that this trade took about 17 minutes to play out fully, and it was almost 3 risk to reward. Alright, so just before we leave the video, I want to tell you that down below you have some free stuff that you can of course claim for completely free. So no tricks at all, just go down there and see what is available. Also, if you maybe want to get a propfirm account, there is also going to be some links down there for you to, of course, get a prop firm account. And then one more, and the biggest thing of them all, is if you want to apply to the one-on-one mentorship, so not a group coaching but an actual one-to-one mentorship, make sure to check out the link down there to actually apply, and maybe you get to be a part of the mentorship. So with all of that being said, I hope that you enjoyed the video, and I'm gonna see you in the next one. Peace.